In 1929, the stock market crashed and the United States plunged into the Great Depression. Over the next 3 years, stocks fell. A staggering 89% unemployment soared to 25%, and it took roughly 25 years for the market to claw its way back to its 1,929 peak. In 2008, history repeated. In a different form, the housing bubble burst. The S&P 500 lost 57% of its value. In just 18 months, unemployment hit 10%, and it still took about 5 years for investors to recover their losses. Those crises were brutal, but today's setup is fundamentally more dangerous. We are not dealing with one bubble, but with an everything bubble, stocks, bonds, and real estate all inflated at the same time. The safety valves that rescued the system after 1929 and 2008 are gone. The Federal Reserve cannot simply slash interest rates to zero again without reigniting the worst inflation in 40 years, and it cannot print unlimited money after already expanding its balance sheet into the trillions. Meanwhile, Washington is drowning in more than $36 trillion of federal debt, leaving little room for another round of multi-trillion-dollar bailouts. When you connect these numbers, the conclusion is unavoidable. This is not wild speculation or fear-mongering. It is basic arithmetic, and it points to a crash window between November 2025 and June 2026 that could rival or even surpass the worst financial disasters in modern history. For anyone paying attention, the warning lights are flashing. To understand why 2025 is different from every previous crash, you need to understand that we're not in one bubble, we're in 3 bubbles at the same time, something that has never happened before in financial history. The first and most obvious is the stock market bubble. The S&P 500 is trading at a price-to-earnings ratio of roughly 28, nearly double the long-term historical average of 15 to 17. This level of overvaluation has only been seen twice before, in 1929, just months before stocks collapsed 89%, and in 2000 before the dot-com bubble burst and wiped out 78% of the Nasdaq's value. In both cases, investors were convinced the rules had changed. They hadn't. But what makes the current market far more dangerous is the extreme concentration risk. Just 7 companies, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla, account for approximately 30% of the entire S&P 500's market capitalization. That's an astonishing level of dependence on a handful of stocks. If these 7 companies decline, they don't just drop individually, they pull the entire market down with them. No period in modern financial history, not even 1,000, 929 or 2000, showed this level of fragility concentrated in so few names. Then there is Nvidia, the most glaring symbol of speculative excess. The company trades at a P/E ratio above 65, more than twice the already elevated P/E of the broader index. Its market value exceeds $3 trillion, making it worth more than the entire German stock market, even though Germany is the world's 4th largest economy. That kind of valuation isn't grounded in traditional fundamentals. It's driven by a powerful narrative: AI will change everything. And long-term, that may be true. But history shows that when a transformative technology emerges, whether electricity in the 1,920 seconds or the internet in the late 1,990 seconds, investors routinely overprice its short-term impact. In 1999, the belief that the internet had created a new economy fueled a bubble that eventually collapsed. The same thing is happening now with AI. The second bubble is real estate, and it's actually more overvalued than the 2008 housing bubble that nearly collapsed the global financial system. As of November 2025 US, home prices sit roughly 50% above their long-term historical trend when measured against income and rent levels. For comparison, at the peak of the 2008 bubble, homes were only about 35% above trend, which means the current overvaluation is approximately 43% larger than the bubble that triggered the Great Recession. Many Americans don't realize this because high prices have persisted for years, creating the illusion of stability, but the underlying math shows a market stretched far beyond fundamentals. And residential housing is only half the story. The real danger is forming inside commercial real estate (CRE), where a slow-motion collapse is already underway. Office buildings across the country sit at 45% vacancy, while cities like San Francisco face vacancy rates near 35%. These properties were originally financed when interest rates were around 3%, but now those same loans must be refinanced at 7% to 9%, more than double or triple the prior cost. The buildings simply don't generate enough cash flow to support debt at those higher rates, leading to defaults that directly hit banks' balance sheets. This dynamic mirrors the 2008 crisis, but with one critical difference: back then, the epicenter was residential mortgages. This time the stress is erupting inside commercial properties instead of residential. The third bubble, and this is what makes 2025 unprecedented, is the bond market. For decades, U.S. government bonds were the safest asset in the world, the place investors fled when stocks crashed. But in 2025, Bonds are falling at the same time as equities, breaking the traditional safety correlation that markets rely on. The underlying reason is simple: the debt burden has become unmanageable. Federal debt now exceeds $36 trillion, equal to roughly 125% of GDP, a level previously seen only at the end of World War II. But unlike the post-war era, the U.S. is no longer the world's only intact manufacturing engine with decades of expansion ahead. Today's economy is slower, more fragile, and far more dependent on borrowing. The most alarming figure is the annual interest bill. The government now pays more than $1, $2 trillion every year just in interest, making it the largest expense in the federal budget. It now costs more to service the debt than the country spends on defense, and even more than it spends on Social Security, the most politically protected program in America. When interest becomes the government's biggest bill, the math simply does not work anymore. That leaves Washington with only 3 choices, and all of them end in crisis / spending triggering recession. Raise taxes sharply, also causing recession. Print money to cover interest, unleashing inflation. With no painless option left, and with stocks, real estate, and bonds all showing signs of extreme stress, this is the everything bubble. The parallels between 2025 and 1929 are so precise that it's like watching history repeat itself, only this time with more leverage, broader exposure, and far fewer safety mechanisms. The first and most obvious similarity is valuation. In 1929, the Dow Jones Industrial Average traded at a price-to-earnings ratio of roughly 33, a level that signaled extreme speculation even during the height of the Roaring Twenties. In 2025, the S&P 500 sits at a P/E ratio of about 28, dangerously close to those pre-crash levels and nearly double the long-term historical average of 15 to 17. When markets trade this far above fundamentals, history has always delivered the same outcome: a steep correction or a catastrophic crash. But valuation is only the beginning. The psychological environment is nearly identical. In 1929, Americans believed that electricity, the radio, and the automobile had created a new economic era where old rules no longer mattered. Investors truly believed the economy had been reinvented. Today we're hearing that same phrase: this time is different. The justification is new, but the logic is identical. Artificial intelligence will change everything, and therefore traditional valuation rules don't apply. AI may indeed reshape the world just as electricity eventually did, but extreme optimism right before the crash is exactly what defined 1929. Leverage is another dangerous parallel, and in some ways the 2025 system is even more fragile. In 1929, margin debt hit unprecedented levels as everyday Americans borrowed heavily to buy stocks. When the market dipped, margin calls triggered forced selling and wiped out households almost instantly. In 2025, leverage runs deeper and is far more disguised. Investors use not only margin loans but also options-leveraged ETFs and even credit card finance trading to amplify their bets. Meanwhile, corporations have accumulated more than $10 trillion in debt, up from about $2 trillion in 2008, much of it used not for business expansion but for stock buybacks, artificially inflating share prices. Leverage is everywhere, and that makes the system significantly more fragile than in 1929. Inequality forms another striking link between the two eras. In 1929, the top 1% claimed roughly 25% of all income, creating a top-heavy economy vulnerable to sudden declines in wealth. When elite portfolios collapsed, consumption and investment collapsed with them. In 2025, the divide is even sharper. The top 1% controls roughly 32% of national wealth, and the top 10% accounts for nearly 70% of consumer spending. This means any downturn among wealthy households immediately ripples into the broader economy, putting nearly all domestic consumption at risk. But the single biggest difference, and the most alarming, lies in who owns the stock market. In 1929, only about 10% of American households held stocks. While the market crash was devastating for those invested, most families did not see their life savings evaporate overnight. In 2025, the situation has completely flipped. Roughly 58% of households now own equities through 401ks, IRAs, pension funds, or direct holdings. When the market falls this time, it will directly wipe out the retirement savings of more than half the country immediately, not gradually. There is no insulation layer, everyone is exposed. The banking system also shows alarming parallels. In 1929, thousands of small banks operated without deposit insurance, leaving savers vulnerable to immediate loss if a bank failed. Today, while deposit insurance exists through the FDIC, the numbers are wildly insufficient. The FDIC holds about $125 billion in reserves, but guarantees more than $10 trillion in insured deposits. If several major banks fail at once, something already foreshadowed by the 2023 collapses of Silicon Valley Bank, Signature Bank, and First Republic, the FDIC fund would be exhausted within days. The government would face two bad options: let deposits vanish or print trillions to cover losses, triggering inflationary chaos. Even the Federal Reserve mirrors the past in all the worst ways. In 1929, the Fed was inexperienced, but had monetary space. In 2025, after decades of near-zero interest rates, multiple rounds of quantitative easing, and a series of policy missteps, the Fed has burned through both credibility and tools. It can't cut rates to zero without reigniting inflation, and it can't fire up unlimited QE because the last round produced the worst inflation spike in 40 years. Add in a government burdened with $36 trillion in debt and fiscal stimulus is nearly impossible. In nearly every major category valuation, psychology leverage inequality, household exposure, banking fragility, and policy limitations. 2025 mirrors 1,929, but with amplified risk. More importantly, they've lost the tools to fix the next crisis. The 2008 financial crisis provides an even more recent and relevant comparison to what's coming in 2025 and 2026, but the differences show clearly why the next downturn will be far more severe. In 2008, the crisis began in one concentrated area: subprime mortgages. Millions of low-quality home loans were bundled into mortgage-backed securities, MBS, and sold to investors around the world. When housing prices stopped rising, borrowers could no longer refinance, defaults surged, and the value of MBS collapsed. Major banks like Lehman Brothers were leveraged 30-1, meaning a mere 3% decline in asset values could wipe them out completely, and that's exactly what happened. But in 2025, risk is not confined to a single sector. Subprime is everywhere. Auto loans now stretch to 84 months, with average monthly payments exceeding levels most households can sustain. Credit card interest rates are 21% or higher, pushing balances and delinquencies to record highs. Student loan debt has ballooned to roughly $1.77 trillion, with many borrowers unable or unwilling to resume payments. Corporate debt has exploded to more than $10 trillion, up from just $2 trillion in 2008. Much of it borrowed at artificially low interest rates and used for stock buybacks rather than productive investment. In 2008, leverage was concentrated in housing finance. In 2025, leverage is everywhere in the system, in households, corporations, banks, shadow lenders, private equity, and even government balance sheets. The fragility is not isolated, it's systemic. The derivatives market is another danger that has grown exponentially since the last crisis. Today, total notional derivatives exceed $600 trillion, roughly 10 times global GDP. Most of these contracts are interest rate swaps and credit default swaps, which appear harmless during stability but become explosive during volatility. A major spike in interest rates or a wave of corporate defaults could trigger a cascade failure as losses ripple through counterparties in a chain reaction similar to but vastly larger than the collapse of AIG in 2008. The system is interconnected at a scale that simply did not exist 16 years ago. The tools used to save the financial system in 2008 are also far less effective today. Back then, the Federal Reserve had enormous room to maneuver. Interest rates were 25% before the crisis began, giving the Fed space to cut all the way to 0%, which stimulated borrowing and helped soften the crash. The Fed also launched quantitative easing QE for the first time, expanding its balance sheet from $800 billion to $4 trillion by 2014. Those policies stabilized markets and prevented a full collapse. But in 2025, those tools are nearly exhausted. Interest rates are already relatively low by historical standards and cannot be cut aggressively without reigniting the worst inflation spike in 40 years. The Fed's balance sheet is already above $7 trillion after multiple rounds of QE, one after the 2008 crisis, another after the COVID shock. Everyone now understands that large-scale money printing fuels inflation, limiting the political and economic space for another massive QE program. The Fed is trapped between deflationary collapse and inflationary chaos, with no safe option available. Government fiscal capacity is also dramatically weaker than in 2008. During that crisis, federal debt was around 67% of GDP, giving Washington room to launch the $700 billion TARP program and ultimately provide nearly $2 trillion in total backstops and bailout commitments. Today, federal debt exceeds 125% of GDP, and annual deficits remain in the trillions. There is almost no remaining capacity for another rescue of comparable scale. Attempting a multi-trillion-dollar bailout in this environment would risk a bond market revolt, sending interest rates soaring and making the debt burden even more unsustainable. Even the global backdrop is more hostile in 2025. In 2008, China was booming, pouring stimulus into its economy and providing a powerful engine for global recovery. Europe, although affected by the crisis, was not yet drowning in sovereign debt or energy shocks. Coordinated global intervention was possible and effective. The G20 acted together, and major economies supported each other. In 2025, none of that is true. China is struggling with a collapsing real estate sector, local government debt estimated at over $13 trillion, and the demographic decline of a rapidly aging population. Europe faces its own structural problems: energy shortages, slow growth, political fragmentation, and unsustainable social systems. Both regions are wrestling with internal crises, not positioned to support global stabilizing efforts. Geopolitical tensions, from the war in Ukraine to Middle East instability to the threat of conflict over Taiwan, make coordination nearly impossible. In 2008, major economies had the fiscal strength, political unity, and monetary tools to fight the crisis together. In 2025, every major power is weakened, indebted, politically divided, and facing its own internal emergencies. When the next crisis hits, no one will be in a position to step in and lead recovery. Every country will be fighting for survival rather than coordinating solutions. The most reliable predictor of recessions over the last 70 years has been the inverted yield curve. Every recession since 1950 has followed one, and there has never been a false signal. The yield curve inverted in July 2022 and stayed inverted for more than 2 years, finally returning to normal in September 2024. Historically, recessions typically begin 3 to 12 months after the curve uninverts, not while it is inverted. That places the danger window squarely between October 2024 and September 2025, meaning we are now in the exact period where a recession has always emerged. Consumer debt is flashing the next major warning. Credit card balances have surged above $1.14 trillion, an all-time record with interest rates ranging between 21% and 28%. Delinquency rates, borrowers, at least 90 days behind, have climbed to their highest levels since 2011. This matters because consumer spending accounts for 68% of U.S. GDP. When households run out of available credit and must shift from spending to debt, repayment economic activity shrinks quickly. Millions of Americans have reached that point, putting the broader economy at immediate risk. The commercial real estate sector reveals an even deeper structural problem. More than $2 trillion in commercial real estate, CRE mortgages will mature between 2025 and 2026. These loans were originally financed at ultra-low interest rates near 3%, but refinancing now requires 7% to 9% levels that completely break the financial math. Many office buildings no longer generate enough income to service their new debt loads. As a result, property values have already fallen 40% to 60% in major markets such as San Francisco, Los Angeles, Chicago, and New York. Landlords are defaulting, surrendering buildings to lenders, and forcing banks to recognize massive losses, a slow-moving crisis that accelerates as maturities pile up. And the early warning signs have already appeared in the banking sector. In 2023, Silicon Valley Bank collapsed in the second-largest bank failure in U.S. history. Signature Bank failed that same week. First Republic Bank collapsed shortly afterward and had to be absorbed at a loss by J.P. Morgan. In early 2024, New York Community Bank teetered on the edge of failure after reporting huge losses linked to commercial property loans. What's most alarming is that all these failures occurred before an official recession began. These failures occurred even though we weren't in a recession. The concentration of market value in 7 stocks, the so-called Magnificent Seven, creates fragility unlike anything seen in modern market history. Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla together make up roughly 30% of the entire S&P 500, meaning that nearly 1/3 of the index is controlled by just 7 companies. This level of concentration hasn't existed since 1929, and it makes the market dangerously dependent on a small cluster of ultra-expensive tech giants. Nvidia alone represents about 7% of the S&P 500 trades at a P/E ratio above 65, and is valued at more than $3 trillion. If Nvidia were to fall even 50% to 70%, as often happens when growth narratives break, it would drag the entire index down with it. A single earnings miss could become the spark that ignites a broader market collapse. Insider behavior adds another layer of concern. Corporate executives, people who know their company's true financial conditions better than anyone, have been selling aggressively. Jeff Bezos has unloaded more than $13 billion worth of Amazon stock between 2024 and 2025. Mark Zuckerberg has been selling billions in Meta shares. Even Nvidia insiders have been selling into record highs. Historically, heavy insider selling is one of the strongest signals that markets are topping. Insiders sell when they believe valuations are unsustainable and they want to exit before the downturn begins. Then there's Warren Buffett, the most respected investor in history, and someone known for buying during periods of fear, not hoarding cash at the top. Yet Berkshire Hathaway is now holding more than $325 billion in cash, the largest cash position the company has ever had, both in absolute dollars and as a percentage of total assets. Buffett has been reducing Berkshire's massive Apple position and quietly buying short-term treasury bills instead, a clear sign he sees danger ahead. His favorite valuation metric, the Buffett indicator, which compares total stock market value to GDP, now sits around 185%, far above the 120% threshold he has repeatedly warned is dangerously overvalued. When insiders are selling, when concentration risk is at historic extremes, and when Warren Buffett himself is sitting in record cash rather than buying stocks, the message is unmistakable. The world's best investor is sitting in cash waiting for the crash because he knows it's coming. Unemployment has started rising from the 3.4% low in early 2023 to about 1% by October 2025. And while that may still sound low by historical standards, the direction of change matters far more than the absolute number. According to the Somme rule, one of the most accurate recession indicators in modern economics, a recession becomes highly likely when the 3-month average unemployment rate rises 0.5 percentage points above its lowest level from the previous 12 months. As of late 2025, the U.S. is hovering right at that threshold. Once unemployment begins to climb, it rarely reverses on its own. Layoffs trigger more layoffs as businesses react to falling demand, creating a self-reinforcing cycle. Auto loans reveal another major point of strain. About 7.5% of auto loans are now 90 days or more past due, the highest delinquency rate since 2009 during the depths of the Great Recession. The average monthly payment for a new car exceeds $740, and loan terms routinely stretch to 84 months, which masks the fact that millions of borrowers simply cannot afford their vehicles. When auto delinquencies spike, it often signals broader household financial stress. And when people lose their cars, many lose their ability to work, accelerating unemployment and reducing consumer spending. Student loans add even more pressure. Total student debt now stands around $1. $77 trillion in delinquency rates have surged since federal payments resumed in October 2023 after a 3-year pandemic pause. Millions of borrowers are choosing to delay or skip payments entirely because they either cannot afford them or believe they will never pay the debt off anyway. This drains billions of dollars in spending power from younger Americans, the generation that should be driving economic growth. Geopolitical stress further complicates the picture. The ongoing war in Ukraine, recurrent Middle East conflicts, and rising tensions between China and Taiwan have fragmented global trade and destabilized energy markets. Any escalation, especially in the Middle East or the South China Sea, risks triggering an oil price shock reminiscent of the 1,970 seconds which produced the worst period of stagflation in modern history. Markets hate uncertainty, and 2025 carries more geopolitical risk than any period since the Cold War. The commercial real estate market offers yet another sign of fundamental weakness. Some of the largest institutional property owners in the world have already begun to default. Brookfield, one of the biggest real estate conglomerates globally, has walked away from major office towers in Los Angeles. Blackstone, the world's largest commercial real estate owner, has faced heavy redemption requests from investors trying to pull their money out of its real estate funds. When sophisticated players, the so-called smart money, abandon properties, it signals that the economics no longer make sense at all. These defaults are only the beginning. As more commercial mortgages come due at much higher interest rates, landlords will increasingly hand properties back to lenders. When banks receive buildings worth 40% to 60% less than the outstanding loan, they are forced to recognize massive losses. And when losses pile up across dozens or hundreds of institutions, it becomes a systemic problem, triggering bank losses, more defaults, and eventual bank failures. The crash won't announce itself with a clear starting point that everyone recognizes. There won't be a headline that says, "This is it, the collapse has begun." Instead, the next financial crisis will likely start with something that seems small, containable, even routine. It could be an earnings miss from a major tech company. It could be the sudden failure of a mid-sized regional bank. It could be a geopolitical flare-up, a missile strike, a naval confrontation, a political assassination that spikes energy prices overnight. It could even be another debt ceiling showdown in Washington that pushes the U.S. within inches of technical default. Any of these triggers might look manageable in isolation. But in a system already stretched to record levels of leverage, valuation, excess, and structural fragility, any single shock can be the spark that ignites a full-scale cascade. One of the most likely flashpoints is the stock market itself, specifically the Magnificent Seven. If Nvidia, Apple, Microsoft, Amazon, Meta, Alphabet, or Tesla even slightly disappoints on earnings, the reaction could be immediate and violent. Nvidia is the linchpin it represents, about 7% of the entire S&P 500, and trades at a P/E ratio over 65, pricing imperfection. A single earnings miss could send Nvidia down 10% to 15% in one day. Because the Magnificent Seven move in tight correlation, such a drop would likely pull the group down 20% to 30%, dragging the broader S&P 500 lower by 6% to 9% almost instantly. a fall that sharp would break investor psychology. But the deeper danger is what happens next: margin calls. The modern financial system is soaked in leverage: retail traders using margin and options, hedge funds using prime broker credit corporations, borrowing billions to buy back their own stock, and households using credit cards or personal loans to invest. A sharp decline forces brokers to demand more collateral. Millions of investors won't have it. Their positions will be liquidated automatically. Forced selling pushes prices lower, which triggers more margin calls, which triggers even more forced selling. This is the self-reinforcing downward spiral that turned the 1929 market break into the Great Crash. As the sell-off accelerates, institutional risk management systems come online. Pension funds, sovereign wealth funds, university endowments, and major investment firms use algorithmic rules that require them to cut exposure when losses breach certain thresholds. These aren't emotional decisions, they are automated mandates. When the S&P 500 falls 20%, many of these systems begin selling. When it falls 30%, the pressure intensifies. These automatic triggers ensure that once the market breaks, it is nearly impossible to stop the decline through human intervention. While stocks are melting down, the bond market becomes the next fault line. In past crises, investors fled stocks and ran to treasuries for safety. But in 2025, the treasury market itself is dangerously unstable. The federal government must refinance trillions in existing debt, while also issuing trillions more to cover annual deficits. Investors running toward treasuries at the same time the government is flooding the market with new supply creates what analysts call a doom loop. Falling stock prices push investors into treasuries, but huge treasury issuance pushes prices down again. Falling prices push yields up. Higher yields increase the government's interest expense. Rising interest payments require more borrowing. More borrowing increases treasury supply. More supply pushes yields even higher. This spiral is mathematically unsustainable. It ends either in default or in money printing, neither of which stabilizes markets. As stocks and bonds break down simultaneously, the housing market freezes. Buyers vanish, sellers refuse to slash prices, and transactions grind to a halt. Eventually, financial pressure forces sellers to cut their prices. Home values begin declining 20% to 30%, and in overheated markets like Austin, Phoenix, Boise, and parts of California and Florida, 40% to 50% declines become realistic. Millions of recent buyers, especially those who purchased between 2021 and 2024, find themselves deeply underwater. Commercial real estate collapses even faster. More than $2 trillion in commercial mortgages come due in 2025 and 2026, most financed at 3% rates that no longer exist. Refinancing now requires 7% to 9%, a cost most buildings cannot support, especially with office vacancy rates at 45% nationwide and nearly 35% in San Francisco. Landlords simply stop paying and hand the keys back to lenders. Banks receiving buildings worth 40% to 60% less than the outstanding loan must recognize enormous losses. Then the banking panic begins. Depositors watching the news, remembering Silicon Valley Bank, Signature Bank, First Republic, and the near collapse of New York Community Bank panic, they start pulling money not just from troubled banks, but from any bank they suspect might be vulnerable. Digital banking accelerates the run. Tens of billions can move in hours. Banks must sell assets at fire sale prices to raise cash. Even healthy banks cannot survive massive sudden withdrawals. As more banks topple, fear spreads, causing more withdrawals in a self-reinforcing spiral. The FDIC steps in, but its fund contains only $125 billion, barely enough to cover a single large bank failure. With over $10 trillion in insured deposits nationwide, the FDIC is quickly overwhelmed. At this point, the government faces a catastrophic decision: let depositors lose money, risking widespread public panic and political collapse. Print trillions to backstop deposits, risking a currency crisis and runaway inflation. Both outcomes are disastrous. Neither restores stability. Meanwhile, unemployment surges. Tech firms cut 10% to 20% of their workers. Financial companies slash headcount. Retail, manufacturing, transportation, and hospitality collapse as consumers stop spending. Within 3 months, unemployment rises from approximately 4% to 7% or 8%. Within 6 months, 10% becomes likely. Within a year, 12% to 15% unemployment is possible, Great Depression levels. At this point, the entire country looks to the Federal Reserve for rescue. But the Fed is trapped. If it cuts interest rates sharply or launches another round of quantitative easing, inflation will return with a vengeance, the dollar will weaken, and Treasury yields will spike. If it does not cut, hoping to keep inflation contained, the economy will collapse further, turning recession into depression. Every tool creates a new crisis. Cutting rates saves markets but destroys the currency. Holding rates destroys markets but saves the currency. Printing money protects depositors but risks hyperinflation. Refusing to print money protects the dollar but lets banks fail. There is no solution that avoids pain. There is only a choice between different forms of collapse. There is no middle path. For the average American with a 401k or IRA, watching their retirement account decline 60% to 70% will be devastating in a way that goes far beyond numbers on a screen. Someone who spent 3 decades saving and built a retirement balance of $600,000 will open their statement and see $200,000 or less. That isn't a setback, that is the destruction of their financial future. They won't be able to retire when planned. Many will have to work an additional 10 to 15 years, assuming they can even keep their job through the recession. Millions of Americans in their late 50 seconds and early 60 seconds will find themselves facing a retirement timeline that suddenly moved a decade further away. For those already retired, the impact is even harsher. Retirees rely on portfolio withdrawals to pay monthly expenses. When markets crash, they are forced to sell assets at the bottom in order to survive, locking in losses they will never recover. Even if markets eventually rebound, the money they sold during the downturn is gone forever. The comparison to Japan is telling. After Japan's 1990 market peak, it took 34 years for the Nikkei to return to its previous high. An entire generation of Japanese retirees never recovered their wealth. A similar timeline in the U.S. would mean today's retirees would never see their portfolios return to 2024-2025 levels. Housing wealth will be wiped out in parallel. Anyone who bought a home in the 3 years leading up to the crash risks ending up deeply underwater, owing far more on their mortgage than their home is worth. These homeowners become trapped, unable to sell, unable to refinance, unable to move for better job opportunities. Meanwhile, young Americans graduating into the 2026-2027 job market will face one of the worst hiring environments in modern history. Studies of those who graduated during the 2008 recession show they earned significantly less over their entire lifetimes compared to those who entered the workforce just a few years earlier. The next generation may experience an even steeper, longer-lasting income penalty. Small businesses will suffer catastrophic losses. Local restaurants, neighborhood shops, family-run services, independent contractors, and small manufacturers will collapse by the hundreds of thousands as consumer spending dries up and credit becomes nearly impossible to obtain. In the post-crash economy, large corporations with deep cash reserves and access to capital markets will survive and consolidate power. The small business sector, historically the backbone of American economic mobility, will shrink dramatically, leaving a landscape increasingly dominated by megacorporations. Social safety nets will face unprecedented strain. As unemployment surges and tax revenues collapse, demand for welfare programs will skyrocket at the exact moment government budgets are most constrained. Lawmakers will be forced to choose between cutting essential services or dramatically increasing deficits. Either option triggers severe consequences. Spending cuts during peak unemployment create humanitarian crises, while higher deficits push interest costs even further beyond control. And these economic pressures will spill over into politics. When people lose their homes, their savings, their jobs, and their sense of security, they begin looking for someone to blame or someone who promises radical solutions. The Great Depression fueled extremist movements across Europe. Hyperinflation in Weimar Germany set the stage for authoritarian rule. A deep, prolonged American downturn could trigger a similar dynamic, rising support for populist and extremist movements, distrust of institutions, fragmentation of social cohesion, and increasing openness to authoritarian policies. The 2025 crash will reshape American politics in ways we can't predict, but that will likely be destabilizing. So why is 2025 worse than 1929 and 2008 combined? Because each of those historic crashes involved one primary bubble, while the current environment contains all of them at once. In 1929, the crisis was driven by a stock market bubble fueled by extreme valuations and margin debt. In 2008, the crisis erupted from a housing and financial system bubble built on subprime mortgages and leveraged banks. But in 2025, the U.S. faces the stock bubble of 1929, the debt and housing bubble of 2008, and an entirely new threat, a sovereign debt bubble driven by more than $36 trillion in federal liabilities. This triple bubble structure is unprecedented in U.S. financial history. It means every major asset class, stocks, real estate, and bonds is inflated simultaneously. When one breaks, they all break. And unlike in 1929 or 2008, policymakers no longer have the tools to rescue the system. The Federal Reserve cannot simply cut interest rates back to zero without reigniting the worst inflation in 40 years. It cannot rely on unlimited quantitative easing because the last rounds of QE already pushed inflation to dangerous levels and expanded the Fed's balance sheet to more than $7 trillion. Meanwhile, the federal government no longer has the fiscal room to launch massive bailouts. With debt at 125% of GDP, Washington cannot repeat the $700 billion TARP program or the multi-trillion-dollar backstops used in 2008. All 12 warning signs are already flashing red, a yield curve that uninverted in September 2024, historically signaling recession within 3 months. Regional bank failures in 2023, 2024, collapsing. Commercial real estate, record consumer debt and rising delinquencies, unprecedented insider selling, Warren Buffett holding $325 billion in cash, and extreme equity concentration in the Magnificent Seven. Each indicator is concerning on its own. Together, they form a single message. Based on historical timing, the yield curve signal plus the $2 trillion commercial mortgage maturity wall, the recession and crash window, sits between December 2025 and September 2026. The projected damage is far beyond a normal correction. Stocks could fall 65% to 80%, bonds could drop 35% to 50%, real estate could collapse 40% to 60%, unemployment could exceed 15%, and recovery could take 10-20 years or longer, much like Japan's 34-year climb back to its 1,990 high. This is why analysts call it the everything collapse. There is no single fault line to contain, no isolated bubble to deflate, no easy lever that policymakers can pull. The conditions that created the prosperity of the last 40 years, cheap debt, low inflation, global cooperation, and monetary rescue capacity have all reversed. The kinds of crashes most people thought belonged only in history books are preparing to repeat in real time. The crash is coming. The only question is whether you'll be prepared when it arrives.